the tax payable on eligible dividend income is reduced through the enhanced uh, dividends grows up, and the tax credit and the dividend tax credit. So dividend, they have a tax credit. Okay, when we're talking about the dividends, which is I'm going to tell you, and capital gain, keep in your mind, is 50% of capital gain is taxable. Okay, 50%, and like the for this one, like I tell you, I tell you that the joke is last evening, um, my husband and me, we walking around, we walking after the evening, we walking, then we just talking about the house price. Now the house price is goes to crazy. I think that in March, then we just talking about one of our the rental property. Okay, so we just make then we said, then my husband says, if our rental property, that house is goes up, because we purchase is 400 something, right? So now it's 400,000 something. Now it's come to 600 something. So in future possible is very in that in future possible we're not going to sell it. Okay, in the future it's possible 800 something. So then my husband said, okay, so its capital gain is going to 400 something, right? If sale price is 800,000, because the purchase price is 400,000, right? So compare that is 400,000 capital gain. Then he said 400,000 capital gain, we pay lots of tax on it because you sell it in 1 year, right? Then plus your income, plus your employment income. So it goes to very high. So probably you pay the 48%, half the half tax. Then he said it's very high. Then I said, okay, for the capital gain, the government they give you is only 50% is taxable. So 50%, that means 200,000 is taxable. Then he said, how about another 200,000? So another 200,000 go where? That's the funny, because he knows nothing about the tax. I said another 200,000, so that you have it. The government won't charge you anything on that. Okay, so only 200,000 is taxable. So that taxable is taxable is according to your tax bracket. So what tax bracket? If your tax bracket is 48%, is 48%, that means almost half. Then you pay 100,000 tax on it, right? So then he said still loss. I said yes, still loss. Of course, it's still loss. This is why I already prepared that. Okay, I already prepared it. Then I will talk to you how you prepare in 1 year, because if you sell your rental property or something, but your principal house is tax free. Okay, you don't need to pay the tax. But if you sell your rental property, okay, or you sell like a warehouse, you're running business, you sell your warehouse. So in this case, that you have to prepare, because the real estate property, they usually can have a capital gain. And now in Calgary, now that the house price from last summer to now until now, it goes very, very quick, very sharply. So then in this case, the capital gain is you prepare get large capital gain. So if you get a large capital gain, then plus your income, you normally have an employment income, self-employment income, add up, then your tax bracket is very high. Okay, then you add up, tax bracket is very high. So you don't like that very high tax credit. Like I said, if I got 20 thousands, then you plus employment income is still you pay a loss tax. So in this case, we have a RRSP, okay? We have a RRSP. In this case, your contribution RRSP, then bring your income is down, okay? Then I will tell you when got capital gain that, okay? Okay, then also I'm going to talking about RESP, okay? Little bit RESP. Little bit RESP and the TFSA. Okay, so we compare RRSP. Then I'm going to compare RRSP. You have money, for example, you have 8,000 by end of year. You have 8,000. So 8,000 you can put your saving account, right? Your checking account, your saving account, or you put your TFSA account, or your contribution RRSP, or somebody, if you have kids, then somebody thinking they purchase the contribution RESP. So you have a lot of choice. Which one is best? Okay, which one is best? Then I will put this topic in the last. Okay, the last one when we finish, almost finish that investment income, we just wrap up. So I'm going to give you some suggestion. Okay, it's not always true. It's not always true. Okay, it's just depend on somebody. Okay. Let's start with interest. The first topic is interest. This one. Okay, interest. Okay, not yet. So basically the interest. So the interest, like I said, the interest is you have a saving. You have a saving account. You put the money in your saving account, right? Then you're earning interest. So the interest is if you put the money in the bank, okay, the bank, you will get a T5. I believe somebody have a T5. So the T5 is most time is show you the T5. Okay. Let's see. The T5 is most time is from the bank. Okay. I think that most students they get T5 from that. So I'm going to show you what T5s looks like. So okay. Basically, this one's a T5, okay? If you look up T5, T5 is this one's from TD Bank, okay? That's the TD Bank. So T5, keep in your mind, T5 is from the bank, okay? Then if you see, this is the tax year, okay? Tax year. And this one is, they put the two name here because of the joint account. Okay, that's the joint account, husband and wife joint account. So they just the joint account. So joint account on the box 13 is interest. Box 13 interest, then they have 800 something. Okay, 802 $23.66. So this one is showing a joint account because they have this couple, they put money in there, then they make this joint account. So you keep in your mind. So the joint account, I'm going to tell you who is going to report that interest, right? Then if it's not a joint account, that's easy. If only on the Judy, then your Judy report your Judy's is going to put on Judy's T1. But now this one is joint account, so you need a split. Okay, you need a split, or you need to split that amount. Then how you split that amount is according to your principal. Okay, according to your principal, that's $823.66 is if you put the GIC, like for example, is from 10,000. So the 10,000 from who? Is from Leaf or from Judy? Okay, and then if sometimes sometimes it's harder. Sometimes it's harder because the joint account, they share expenses, they share home expenses, share a lot of things. It's harder to see, and that's the money is left, 10,000, that the money is saving. It's hard to see from who, okay? It's harder to see from who. So in this case, the good chance is half and half, okay? And then you split half and half. But if you know, like 60% from Leaf, and 40% from Judy, then you just 823 times 60%, or 823 times 40%. Okay, as long as you know, you have to separate. If you don't know, they are share. Okay, they share expenses, they share living expenses. They doing so that the saving is harder to see. So then they half and half. Okay, so for most time is like, if you don't have another easy way is for joint account, like for me, for my family. So we don't have a lot of interest. Okay, we don't have a lot of interest. I will tell you, if you have money, you have a like after you have a TFSA, then you put TFSA. Then you don't need to pay any interest. You don't have any your interest. If you have an interest, you don't have pay any tax on it, right? So TFSA and RSP or RESP, you don't pay any interest. This money is only you put in your saving account, or you purchase a GIC, as the money is from a saving account, so you get this money. So for my family, I don't have a lot of interest. I do have a T5, but the T5 amount for 13 is not big amount. It's only 50, 60. So in this case, it's 50, 60. Even there's a joint account. So it's not necessary you have to break down half and half. Only $60, 30, it doesn't make any difference. So in this case, I just put on the person with high income, put under my husband's T1. That's it. So it's easy. Okay. So keep in your mind, that's your choice. So the one thing you have, if you know that principal is from how many percent from from husband, how many percent from wife, then the interest is the interest that you split according to the percentage. Okay, so this one is technically is from income tax act, income tax law, right? Income tax act. So, but in real life, it's harder. Sometimes it's harder to see how many percent is from husband, how many percent for wife. So you just split half and half. Okay, half amount is under husband's T1, half amount is under wife's T1. And some case, in my case, if I don't have any very big amount, it's only a couple, it's just 50, 60 or 80 something. So I just put all on person with high income. Okay, don't put the person with low income. For the person with low income, CRA will come to you. But you put the whole amount on the person with high income, then the CRA won't say anything. Okay, because it's good for them, right? So so that's basically keeping your mind. Okay, so this one is for joint account. Okay, if it's only not joint account for your personal account, is only for your personal account, then you directly put down your name. That's easy, right? That directly is only for joint account. Some people is confused. So so this one is the SIN number. Okay, this one is the SIN number. So the SIN number, they only put the first person here, leave. Okay, for leaves first, the SIN number here. They don't put the both. Okay, they put the name on the top, then there. Okay, I'm going to talking about 13. So box 13, when you do tax return, when you let me open that. Okay, let me open that Stadio tax. Stadio tax for T5. Okay, T5 is kind of easy when that is similar like T4. It's kind of easy, but only box 13 is something you need to pay attention to it. Okay. Why this? So T5 is here. So Cindy, for example, Cindy, okay, I click on T5, then the T5 is here, okay? So for the interest, this says box 13. So do you think that how many box 13 are there now?
3, ma'am.
3.
That's 3, right? So some student they confuse that's 3 because like says T5, they only show me here. The T5. So only show me $823.66 is box 13. They only show me box 13. So when you do tax return, you don't know, right? Then when you do your tax return, you don't know which one you need to put. Okay, just hold on. Okay, now I want somebody to read that box 313. The first 13 I want student to read.
Interest from Canadian sources. Bank interest
That's the bank interest, okay? So keep in your mind the bank interest that you put the first 13, okay, the top one. Second one. Second one.
Interest from Canadian sources, bond interest.
Yeah. So this one is bond interest. The second one is bond interest. Then the last one is
Interest from the Canadian sources from the mortgage interest.
yeah. So that's the mortgage interest. Okay. So the mortgage interest, if you know, there's all Canadian source. If the foreign source, that's not here. Okay. The foreign source is about box 15 somewhere. Okay. So box 15, because the foreign source is and the foreign source, they have a deduct. You have to pay the tax in the foreign country. Then you already paid the tax. Okay, so that's 16. This has a foreign tax. So anything, if you got the T5, if you got T5 on box 13, you have to recognize is bank interest or bond interest or foreign mortgage interest or mortgage interest. Okay, that's three things. So I tell you, most time is bank interest. Okay, you're going to know bond interest. The bond, I'm going to teach you what is the bond. So the bond is a certain amount, right? Then it's a big amount you purchase. Then when the material day, then you just redeem, then you get interest for that. And I'm going to talking about the T-bond. T-bond is called the treasury bond. So for mortgage interest is that situation is very bare, okay, very few. So most people is got interest, bank interest, okay. So that's easy. And T5, when you do T5 return, if you have a box number, you just fill the box number. That's it. Okay, very easy. There's nothing complicated. Now we're just talking about T3. The T3 is so normally the T3 is issued by financial institution. So I share my screen, right? Everybody, you see T3?
Yes, ma'am.
Okay, so T3 is, you see, if you see here, this one is called the RBC Trust. Okay, so this one, RBC, not RBC Bank, okay, not Royal Bank. So this one is the financial, okay, the financial institution. So anything from financial institution is T3, they issue T3. So the T3, the first thing is you see, if you see that's the 49, box 49, 50, 51. This one I'm going to teach you. This one is for dividend, okay? And the dividend is eligible. This one's eligible dividend, okay? Eligible dividend. So 49, 50, and 51. Okay, so this one is 250 is actually amount. So that 345 is taxable amount. Then box 55 is credit, dividend credit. So we're going to talking about now. You just know, okay? Then after I'm going to talking about that. So box 21. So what things on box 21? Box 21 is capital gain. Okay, is here. Then box that's box 26. Box 26 is other income, not other income. Okay, And then the management fee. Okay, they have a management fee. What management fee is? Management fee is RBC Trust. They take care of. They take care of Miss Brick's account. So Miss Brick have a dividend, have a capital gain, have a loss of investment in RBC Trust. So RBC by the end of the year, okay, they charge Miss Brick's management fee. Okay, so this management fee is we can deductible. Then I'm going to tell you how you report this one. Okay, how you report this one. So because management fee is not box number. You don't have a box number, right? So this one, they easy. They have a box number. So as long as you have a box number, then is easy. But management fee, they don't have a box number. So how you report this one? Okay. So now, I'm going to tell you how. So let me take a picture. Then I tell you how to report. Okay. Here, for example, is Cindy. Okay, for example, Cindy is doing that. This one's T3, right? So you click on T3. You click on T3. For example, that's the Cindy's T3. Okay, then you click on T3, because this says T3 is pretty simple. So the box 49. So box 49 is here, okay? Actually amount of dividend. So box 49 is here. So box 49 is 250. And box 50 is 345. 345. Then box 51 is credit. I'm going to talking about that, okay? So today, I just do how to, if you have a T3, how to report it. So that's, and then box 21. Box 21 is capital gain. So box 21, you just put 12476. So as long as they have a box number, so it's easy. Okay. Box 26. Box 26 is 37850. Okay. So you're done. Then basically you're done. But management fee, they have a $254.65. There's nothing here, right? There's no box number. Then you cannot put anything here. How you put here? How you put that management fee? Okay. So the management fee, I tell you, you click on T1. You click on T1. So the management fee is in page 4. It's deductions, okay? Page 4, deductions. The deduction is line 43, okay? Line 43. You keep in your mind, okay? So line 43, what we called carrying charge, interest expenses or other expenses. So what this other expenses is management fee, okay? The interest expenses is what? Is when you do investment, like you purchase a stock, or you do some investment, you want to have share in some company. So you don't have money, you can borrow, you can borrow the money from bank. So when you borrow the money from your bank, then you pay the interest for that, right? You pay bank interest. So we said interest expenses. So because investment, you do investment, because you do investment, you pay the tax. Then you do investment, you pay tax. Then you expenses, according to the expenses, then you have then allow you to deduct. Okay, so we call the carrying charge, interest, expenses, and the other expenses like a management fee. Like I said, the management fee. The management fee we put in here, so that because this one is not yellow, right? So not yellow. This says federal worksheet. So you double click on here, then they will give you a federal worksheet. So federal worksheet, we know that's the carrying charge. So carrying charge is on next page, second page here. Line 22100, carrying charge in the interest income. So that the first thing is interest expenses. The second one is other expenses. We put other expenses here. What you put other expenses is here is RBC Trust. Management fee. Management fee paid. RBC Trust from T3. Okay, I want you to put here the management fee paid to RBC Trust from T3. Okay, so you put here, then you put the 2, then this one is still white. So you still cannot put here. So you put over here because there's a possible they have more than one item. So this one is you put 255.65. 254.65. Then you put RBC Trust the management fee. Management fees, okay? Then you put okay. Then they will appear here, okay? It will appear here, 43, okay? 43. So keep in your mind because that's difficult things is management fee, because management fee they don't have a box number. So that's they allow you to, then also the management fee, they allow you to deduct, okay? When you purchase a stock, when you purchase a stock or you sell stock, then that one they have a exchange fee or transaction fee. So that fee is you cannot put here, okay? That fee you cannot put here. That fee is when I'm going to teach you that if they says management fee, you still can put over. You cannot put over here. You put on this when you calculate capital gain. When you calculate the capital gain, you subtract. Okay, it's called cost, because any fees you paid related to your stock is you can when you calculate capital gain is called cost. You can subtract. Okay, so your capital gain is getting decreased, but you cannot put over here. Okay, this one is the management fee is the sum is that financial institution or bank they take care of your account, investment account. Okay, so it's here. So but somebody asked me, how about RSP account? So if you set up RSP account in some financial institution or some financial group or the bank, The bank normally they don't. The bank is depend. Okay, if you interest, the bank is if you only put earning interest, so the bank won't charge you any management fee. But if you purchase stock, they will going to charge you. You have a stock investment, you have bond or have a mutual fund. It's lots of things. Then this one is they will charge you a management fee. For that management fee for related to RSP, related to your TFSA, then it's not deductible. You cannot put here. Okay, you cannot put 43. Why? Because I tell you, you remember, I said all the deductions is related to your income. Is related to your income. For RSP, RESP, TFSA, the investment income under this account, under your TFSA account, under your RSP account, under your RESP account is tax-free. So that when you get interest, or get income from that account, they bring you produce income from that 3 account is not taxable. You don't need to put anything in here. Okay, you don't need to put anything in T1. So in this case, there's no income tax. No income tax taxed. So there's your related expenses you cannot put in here. Okay, you cannot put in here. I forgot to tell you the interest income, where you put the interest income. So basically, interest income is line 10. Okay, the line 10 until line 10 is interest and then other investment income. Okay, is line 10. So line 9 is a taxable amount of dividend from taxable Canadian corporation. Okay, so that's the dividend. So the dividend is the line 9 including two kind of dividend is eligible and other than eligible. Okay, it's line 9. So line 1 to 0, 1, 10 is the other than eligible. This one is a reference. Okay, so if you use line 9, the CRA will use line 9, subtract line 1 to 0, 1, 10, then they will know how much eligible dividend you got and how much other than eligible. Okay, so CRA will they will have an idea. Okay, so for the dividend, I'm going to tell you later what is eligible and other than eligible. So capital gain is on line 14. Okay, capital gain is on line 14. So on line 14, they'll have. So when we got a T, do you remember we have a T4, T3? So the T3, capital gain is 120. We've entered $124.76. Then they only get taxable. The system is automatically take 50%. So it's come to $62.38. Okay, $62.38. They automatically come here. So this one is only that is from T3. So if you have a T3, it's easy. But sometimes you sell mutual fund, you sell stock, and you sell your rental property. Like I said, I have a rental property. If I sell it, we have a capital gain. So this one is you won't get T3. Okay, so I'm going to teach you Schedule 3. So if you double click on that, then the Schedule 3 is up here. Okay, and the capital gain. So Schedule 3, because the T3 they already fill up T3. Okay, so the T3, they already T3 information. You say T3 information we enter $124.76. They already entered. Okay, directly connect to T3, and the T5 also. If you have a T5, they directly connected. You just enter T3, T5. Then it's easy, but it not easy is here. Okay, and not easy is this yellow one. Okay, the qualified small business cooperation share. When you have a share, you sell it, and the farming fishing, we don't do that. Okay, and then there's a stock. Okay, the stock publicly stock, the stock or mutual fund. Then there's real estate. So the real estate is, like I said, if you have a rental property, you sell it. Then I'm going to teach you Schedule 3, okay? And also Schedule 3, they have a principal resident destination. So if you in 2021, if you sell, okay, in 2021, if you sell your principal resident, you need to fill Schedule 3. Okay, and you need to fill Schedule 3, and also you need to fill T20991. Okay, T2091. Even you don't need to pay the tax on it. Okay, so principal resident, how much money you made, and capital gain on it. So it's taxable, tax free. It's tax free if you're resident of Canada. Okay, it's tax free. It's tax free, but you still need, after 2016, you still need to fill out this form. Okay, you still need to fill out this form. So I will tell you why, because since 2016 in Vancouver, in Toronto, that Ontario, okay, in Vancouver, in Ontario, that's the house prices goes up sharply, so rapidly, so that some people, they make money for that. They make money for that. They, for example, they just they purchase one home, then after 4 months or 5 months, they purchase the second home. Okay, the house B. So now, for example, now he purchased house A. After 4 months, they purchase house B. Then after another month, he purchased house C. Then they move to that. The people is smart. Okay, they move to house A. Move to house A, living for couple months. Then they sell it, because they every month the price is different, right? The price is different, and not like Calgary now. So in March now, this month, the price is increased than the price in last month, the February, and January. So that the price is just very in some area they just compete offer. That's one house, they get the 20 offers, then they compete offer. So if it's popular, it's very popular, then they make lots of money, right? You sell one house. Some people, they sell one house, make 60,000. So in this case, then they move house B, they sell house A. This says house A, I live in house A. The house A is my principal resident house. I sell it. So even you make money like 60,000, you don't need to pay any tax, right? Then after you move to house B, you're living in house B for a couple of months. Then you sell it. Then you move to house C, like things like that. Then you make lots of money. Every house you make a couple. You make like 10,000, 20,000, something. Then 1 year, they make lots of money. So in this case, when the CRA, so that's CRA, before we don't need to fill principal house on Schedule 3. Now they ask you to fill that house. Okay, to fill on here. I'm going to teach you how to recognize what situation A, situation situation 1, 2, 3, what's different? Okay. Then anyway, when we come to here, okay, so if this one happened, then the CRA will find out you sell multiple house in not only one house. You're leaving that house, principal house, is for a couple months, and then you sell like this one. Then you won't get 50%. You won't get that. You won't get that tax free. Okay. That even you don't get 50% of capital gain. For principal resident house, is tax free. You don't need to pay any tax on capital gain. But if you sell that house, you're living that house is for a couple months, then you sell a house in 1 year. You frequent two, then you couple times you sell house too frequently. So the CRA will sink your business income. They are not sinking your capital gain. Even not sinking is a principal resident, not sinking your capital gain. The capital gain is better, it's 50%, but they are don't sinking. They're sinking your business income. The business income is 100%. You need to pay the tax. So the business income is like you resell product. You purchase a product, then you resell it, right? So that is your self-employment. That your self-employment, like I said, self-employment income. The self-employment income, we said the business income, right? So when you got the business income, there's no 50% off. Okay, it's only you subtract your cost. That's it. You subtract your paid realtor's fee. That's it. You 100% to charge. And the line 19, the line 19 is business income, right? So that's the self-employment is business income. The CRA will thinking you're doing business. You purchase house, then you resell it. Purchase house, then you resell it. Is a business income. So the business income, you don't get 50% off. Okay, like capital gain, we know capital gain is 50%, right? So line 14 is capital gain. Then even if you are principal resident, so principal resident, you don't need to pay tax on capital gain. You make money, you don't need to pay any tax. So that's depend. Okay, that's why CRA ask you report. Okay, for some student, they says, I live in that house for 5 years, then I sell it. I sell that my principal house. I move to house another better house. So in this case, you still need to fail Schedule 3. Okay, you still need to fail Schedule 3. Even you thinking you don't need to pay any tax, then the CRA will agree you don't need to pay any tax on it. But you still need to fail. You still need to submit that Schedule 3 and submit T2091. If you're not, then you get a penalty for that. Okay, if you're not, you get the penalty for that. That basically today is I just doing the summary for investment income. For investment income is pretty easy. It's not confused. It's only we have a loss of information, loss of knowledge. Okay, so now because I talking about that line 43 is carrying charge. So carrying charges, lots of people, they don't understand what is carrying charge. So this one is I'm going to let you, we are read together on 5,000 G. So 5,000 G, they state that carrying charge is very in detail, is very help. So we just study at 5,000 G, then we take break. Okay. So you guys is
Ma'am, question.
yeah.
Is it the same thing with stocks? Like, for example, you do trading, like you buy and sell, there will be like 100% tax, right?
You buy and sell for stock.
Mm-hmm. Like,
If you do day trading,
they
if
trade.
you day trading, that's you buy stock and you sell stock.
Mhm.
Is most time normally we just see capital gain, right? Capital gain. But if you do day trading, that's a different situation. If you do day trading is your business income, is self-employment. That means that's your it's kind of your job. Okay, it's
Okay.
kind of your job. So for the day trading people, when you sell stock and you purchase stock, you purchase stock, you sell stock, is your 100%. When you make money, is 100% tax.
Okay.
But if you are for most of us, okay, for most of us, you purchase stock, like you purchase stock today, okay, then probably you hold for a couple months or you hold for even more than 1 year, then you sell it. You are not every day you sell purchase like doing that, because we don't have time, right?
Mhm.
You have to come to work and you have a job, lots of things. You cannot like do the day trading. Like for this case, this you make money is a capital gain. If you lost, is capital lost. And then the capital gain, like I said, if you make money like 500 capital gain, then taxable is 250. Okay, 250 is capital, is taxable capital gain. Then they calculate tax. They calculate the tax on 250, not on 500. Okay, not on 500. Don't like my husband confused. My husband said, if yesterday I talked to him, then he said 500 capital gain. So you just your tax is 250. How about another 250? So another 250 is lost. Then he just confused. Okay, so another 250 is not calculated tax. That means you make $500. They only calculate the tax is based on 250. Okay, like for example, is 15%. If your tax bracket is 15%, that means 15% times 250, not 15% times 500. Okay, your capital gain is 500, but the 15% is times 250, not times 500. Is that okay? So that means you pay less tax on it. Then he is confused. He said, "How about another 250? Another 250 is lost." That's okay. I don't want everybody get confused. I just laugh. Laughing.
So,
That,
ma'am, basically, sorry, ma'am. So basically, you're saying the tax is charged 50% of, like 50% from the capital gains, right?
Yeah, 50% capital gain is normally. But you do day trading is different. Okay, you do day trading is they will CRA will deal with business income. Even you put even you put capital gain, they don't think your capital gain. They think in business income. So like I said, the business income is on the line 19. Line 19, as long as they put the business income, then you only can subtract your costs. Your income subtract your costs, then you 100% to pay the tax. Okay, for the net income, you 100% tax on net income. So there's no 50% deduction here. Okay, the rule. So it's we do have I'm going to give you in later. Okay, in later I'm going to give you example the interest. If somebody interest, we do have somebody. They are in BC. That guy is in BC. They are they're doing day trading. okay, then he report the tax is capital gain. Then the CRA refuse to claim refuse to claim capital gain. They decide the CRA decided is for business income. So in this case, they are fighting. They are fighting on the court. I don't know. I didn't check in this year. I only checked last year. They are still fighting. For that case, I think that person is I believe, okay, for a point of mine. For the point of mine, I believe that person will lawsuit, because the situation is that person is expert, okay. He has a job at stock exchange, okay, and in some financial group, his job is trading, okay, stock trading. So that means he is a professional. Okay. Then meanwhile, and at someday he's doing day trading by himself. Okay, use his own money to do day trading. So in this case, do stock exchange. So in this case, CRA was thinking it's business income. Okay, so I believe so. Because for all of us, we don't have that knowledge for day trading. Okay, that's the first. If they are thinking your business income, so you provide the evidence. Is first thing, I don't have special knowledge. I'm not expertise at the stock trade at the stock exchange market. So I just do some investment. Okay, I just do some investment. I'm not have some special knowledge for doing that. That's the first evidence. The second evidence is you are not doing that very frequency, right? And you're just doing when you have a time, you just purchase stock and sell stock. You look at the stock market. Not every day you're watching the stock market. You know stock market very well. Then today it goes up, and then the next day it goes down. Today they have the company, a group. They just public the public explore their financial. The financial report or something like that. You don't have that knowledge, and also you don't have a time. So that probably CRA was thinking, oh, okay, you're doing investment income, it's capital gain, not business income. But for BC that guy, he is he has expertise at stock market. Okay, he has a knowledge for stock market. That's the one thing. Another thing is he has lots of time. Okay, he's doing that. Even he have a full-time job at stock exchange. But meanwhile, he's using his own money to do day trading. So that's a business income. Okay, that's a business income. It's not. It's business income. It's not. Capital gain. Okay.
Question, ma'am,
Yeah.
question. Yeah, just for example, you buy a stocks or a crypto and then sell it for a certain percentage. You're not doing a day trade. Is it considered business income or capital
No.
gains?
No. As for I said for most of us, it's capital gain. So capital gain is better. Capital gain you get only half, and the half amount is taxable, right? So for most of us, I said it's capital gain, and we're doing investment income. Then when you have money, you're doing investment income. So I said if CRA is thinking that one is usually, for the day trading is sometimes you make lots of money. Right, then the CRA will watch you. If you are not making money, you just lost money. You got for me, like my husband, he lost money for the stock market. So if you for long lost money, you don't need to pay tax. Then the CRA won't come to you. Even you are doing some frequently day trading. Okay, like something like day trading. So if you make lots of money, then the CRA wants your money. You make money, then the CRA want the tax, right? They want your money, take money from you. Then this the important things. And another thing is the CRA will look into it. Then you have a knowledge. You do the frequency, very frequency. Then they will
How
charge you.
frequent,
Okay.
ma'am? Like, for example, weekly, ma'am, you sell stocks or crypto weekly. It
The weekly
depends.
is not, no, weekly is not.
Okay.
Okay. The weekly is not. And also I tell you, you make lots of money. If you make 1,000, 2,000, then the CRA won't come to you. Okay. Then I said that the BC guy is make a couple $1 million. Okay. Then I will tell you they make that money is under RRSP, under TFSA. Okay, so under TFSA, under RSP, so that's even worse. So that then I will, when we go to TFSA and RSP, we just see. Okay, but some people like say you lost money. Like my husband is purchased that stock, they lost lots of money. They got the capital lost. So the capital lost, even he's doing something a frequency, then the CRA won't come to him. So then your capital loss, you don't need to pay the tax. They come to you, they says, okay, it's not, it doesn't make sense, you know, it doesn't make any sense. So we just come to that carrying charge. Okay, we're looking at carrying charge. That capital loss. Okay, that's here, carrying charge. So it's page 18. Okay, here, carrying charge, page 18. Yeah, that's good. If somebody you ask me question is good. I like student to ask question. I don't like the student to keep quiet. Because you ask question, that means you follow me and you are thinking. Okay, you're thinking that some situation. You use your brain. So I don't want you're active. There are lots of people. Some student they just listen and fell asleep even.
I have a quick question.
Okay.
Because I received from my bank, like retirement saving plan contribution receipt, where I'm going to put on my tax.
Contribution for what?
Saving plan contribution receipt, retirement.
Retirement.
Yeah.
That's
our
RSP, right? The RSP I'm going to talking about. Yeah, RSP is very important. I'm going to talking about. You will know how to do RSP. It's very simple and easy, okay? But now I just talking about the interest and the carrying charge, okay? So RSP, possible today or tomorrow, okay? RSP is very easy. You will know, don't worry. The carrying charge, we read carrying charge, okay? Carrying charges in interest expenses and other expenses. So claim the following carrying charge and the interest that you paid to earning income from investment income, from investment. So you make sure that you paid that the interest that you paid, okay, to earning income from investment. That interest is you paid to earning income, okay? The interest that you paid to earn income. If not earning income, that interest is not deductible, okay? Like for example, you paid mortgage interest for your home. for your home, so that interest we can deduct here. Like say, I purchase my principal home. Okay, I purchase my home. Okay, I purchase my home. I paid every year. I have a mortgage. Every year I pay the interest. Okay, every year I paid the mortgage interest. So so can I deduct here? Because you said the interest expenses I
No,
paid.
ma'am. No, ma'am. As
Can
long as
I deduct?
Yes, ma'am.
no, ma'am. As long as it's not as long as it's not what's this, investment income.
Yeah, it's not investment income. It's not you're earning your income. So for that, for this one is your personal expenses. You purchase your own home, your principal home, then you got interest. You pay the interest. So the this interest is not for the purpose. You pay that interest is not the purpose to your earning income. Okay. It's not the purpose related to your earning income. It's the purpose, your personal expenses. It's like something like you borrow the money, you purchase expenses, clothes, you purchase expenses, you pay the money on your credit card, that the interest on your credit card. You purchase expenses, clothes, you purchase expenses, purse. There's something like that. Okay, that's your personal expenses. You cannot put that interest on your T1. Okay, on here, you cannot put interest on here. Then I also ask, how about I pay the interest on my rental property? The rental house I have a mortgage. So the rental house I have a mortgage. Then I paid the interest. How is that? That interest can we can deduct?
I think so, ma'am.
Yes. So
You get
you're
income from
earning-
rental.
yeah, you're earning income, right? Because your rental income is you pay the tax on it, right? So your rental income, so the rental, you rent that house, that rental income, you pay tax on rental income. So in this case, the rental income in this case is the purpose. You borrow that money, the interest that you paid. The purpose is your earning income. Your earning income, then you can deduct, but you cannot deduct on this line, a 22100. You deduct on the rental one. Okay. Then I show you where you deduct it. And I don't want your people, I don't want your student to get confused. Okay. Where you deduct is here. The rental income, see here, the rental income is here, line 13. Okay, the rental income is line 13. So the line 13, you're going to T776. If you don't know T776, you double click on that. Then they give you a T776. So the T776 here, okay, form. T776. Okay, so here, so T776. So this one is for the rental, okay? Like, I just, like here. So the rental on page 2, they have an interest and the bank charge here. Okay, you put the interest here. For the mortgage, you have a mortgage on your rental property. So the interest that you paid is from here. Okay, you paid put here. Put here. That's the expenses for the rental. For this one. So you cannot put online. You cannot put online 40 43. Line 43 is carrying charge and interest expenses. You cannot put the interest here. Even the interest you can, you can claim, but not like this line. Okay, not this line. Is for the rental one. They especially is have a rental one. Okay, line 16, T776. Okay, T776 is a rental income, so that I don't want somebody get confused. So we just carry on. Okay, the fees to the manager or take care of your investment, other than the fee you paid to service in connect with your pool registered pension plan. That's the PRSST, the register. Okay, the registered pension plan. Anything the registered plan is not. Okay, there are the registered retirement income fund and the registered retirement saving plan RRSP, and the SPP. SPP is a specified pension plan, and that's then your tax or your tax saving, your tax-free saving account is TFSA. Okay, this account, they bracket. This account is the management fee paid. That this account is not. You cannot put on carrying charge. Okay, so only that's the fee to manage or take care of your investment income. Okay, so investment income is the money from your saving account. Is not related to your registered plan. So RRSP, RESP, TFSA is a registered account. So registered account is a CRA. They set a special account. That fund is separate from your bank account. Saving account, checking account is separate, another account. So in this case, that's PRPP and RRIF, RRSP, SPP, and the TFSA. So these one, the management fee, it's not deductible. Okay, it's not deductible. Why? Because these one, these ones, so investment income under this plan, we don't need to pay any tax. So if you don't, it's tax free, you don't need to pay any tax, then the management fee, you cannot deduct. Okay, so that the fee is manage your or take care of your investment. Okay, so you can put the carrying charge here, needs this line. Then another one is a fee for certain investment advice. Okay, for certain investment advice, then you can deduct. For sometimes that's advice is you go to specialist. Okay, for the investment specialist, they will they are take care of. Sometimes they take care of your investment income. They look up your profile, then they give you a good suggestion because they have a knowledge on that. They give you and they look into your profile, then they give you advice. They says, okay, this one is not good fund. It's not a good investment. Then I give you I suggest that you move out. You sell this one. Then you move your money, invest money to another fund, so you make money. So in this case, at the specialist, you go there, you need to pay them, right? Then you need to pay them because they use their knowledge and they spend their time to save you. So you pay them. So this money we still call the carrying charge. Okay, we still call carrying charge. But the fee paid investment, that means the fee paid in investment counselor, okay, the counselor to for the recording the investment income, okay. So this one is you can put carrying charge. And another thing, the fees to have someone complete your return if all the following apply. So if you got lots of stock, you sell and you sell your purchase, and lots of things, and because you don't have a knowledge of how to prepare, how to calculate the capital gain, and how to prepare that tax return, because you need to pay the tax, right? So this tax return, you hire somebody, you go to HR block, you hire some specialist, or you hire someone, you paid. That fee is you can deduct here. Okay, you can deduct here. So let's see. Okay, have to someone complete your return. That means your tax return. If all of your following apply, so you have an income from your business, or your property. Accounting is a usual part of operation of your business and property. Then you did not use that amount, claim, reduce that business and the property income you report. Okay, so that business income is the business income, like I said, they just calculate if you're day trading. If you're day trading, then you just put you can claim. If you do the day trading, then you can claim that some people prepare your tax return. You can claim here, or you can claim on that self-employment, that business income, that is your expenses, or your the property. The property is that rental. Okay, so the rental income, you hire somebody to prepare your rental income, right? So the rental income, you have a lot of rental. I heard that some people, they have 10 property, rental property. So every property for individual, you have calculate. And house A, the income and expenses. House B, income and expenses. House C. In this case, you get lots of things. Then you don't have a knowledge. Then you hire somebody to do it. Okay, you hire somebody to do your tax return. So in this case, you paid somebody 1,000. They prepare your the rental income. Then the 1,000 you can claim here. Okay, you can claim here. All the 1,000 you can separate that 10 property. You claim that rental. The rental one I show you. Okay, the rental one I show you, they have a management fee and a professional fee. You can claim there, but you cannot claim both. Okay, you only can claim one. You could claim here for the 1,000, or the 1,000 you separate by the 10 property. Like each have a 100. You put that. Okay, that's both. You cannot beat both. You only can choose one. Okay, you choose one. What's that? I'm going to the carrying charge. Okay, here. Most interest that you paid on the money you borrowed from investment purpose. Okay, the purpose you have to investment purpose, but generally only you use it to try to earn investment income, such as interest or dividend. Then note, if you only earning your investment, if your only earnings, your investment can produce a capital gain, then you cannot claim the interest you paid. And that says if you only earnings, so that you don't have another earning. Okay, you only earning if your only earnings your investment income, so that investment income is only from your capital gain, you cannot claim interest you paid. Okay, that's easy. And then legal fees you incurred related to your support payment that your currently that you currently and the formal sponsor and the common law partner or the usual the natural parents of your child paid will be paid to you. This one is not. This one is interest. Okay. Okay. So I don't think that okay, so the legal fee, make your child support payment. Okay, the legal fee is a note. The legal fee incurred to try to make a child support is non-taxable. Is non-taxable because we said the child support is non-taxable. It's only as only spousal support is taxable, right? So that they says it's non-taxable, must be deducted online to 23200 of your return. But yeah, so that that the child support. So any child support fee, the child support fee, the legal fee is online here. Okay, online here, like I said, is other deductible, is another deduction. So like I says, already says is on this line, line 49. So your other deduction, you just put a child support. Okay, the child support, the legal fee for child support. So that, like I said, the legal fee for child support, because child support is not taxable, but still, the fighting for child support is still deductible. Okay, it's still deductible. But if you're fighting for custody, child custody, and then it's not. Okay, it's not, it's not deductible. You cannot put here. So when you put here, you have to see legal fee for fighting child support. It's on line 49, the other deduction. Excuse. So we just now we just take a break. After the break, we come and after the break we continue. There's a lot of things for the carrying charge. We have to go through all the things, legal fees. Okay, we have to go through a lot of things. And this one is usually that the carrying charge. If you're confused when you're doing something, if you're confused, I want you to read this line. So that's the most detail in here. Let's take a break. I'm going to see you at 10:15.
Okay, thank you, ma'am.
Okay, thank you.